Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello and welcome to another episode of the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I'm joined today by Mike Hardy, who is the co-founder of Cyrus Opportunity Zone Fund, and we're gonna have tons of fun because we are going to talk about, it's our first opportunity, no pun intended, to talk about opportunity zones, and so that's what we're going to aim at and do today. So, Mike, welcome.
Thank you, Brandon. It's a pleasure to be here. I look forward to the conversation.
Yeah, it's be awesome. So, tell us a little bit about how did you get started down? What was the appeal? Opportunity zones came into existence relatively recently. What led you down that path to say, I've got to start a fund?
So it's a kind of funny story. It was by accident. So I was for 2 years, I was the chair of the financial advisor network for AUSA Pacific University. And I've been in the mortgage banking space for a long time, but I'm formally trained and early in my career operated as a financial advisor. So know both worlds well. And long story short, we decided to do some public-facing education for real estate professionals, CPAs, financial advisors, mortgage community. And we were covering all of the different, creative options. Of course, 1031 exchange. We had a DST expert, 721 provision individual was covering, charitable remainder trust, charitable lead trusts. And there was this new kid on the block, the opportunity zone. And we had experts for each area, but we couldn't find an OZ expert. And I said, all right, I will do the OZ section. Let me take a smaller section. We'll do a caveat. I'll do it as an investor, not as an expert. And so I spent the better part of 3 weeks to a month just saturating in the tax law, trying to wrap my mind around it. And it seemed too good to be true. Long story short, I do the presentation and I'm realizing, why are more people not doing this? Okay, this was it 2018 or 19? I mean, it was really new at the time. And so it took about another 6 months of due diligence and realized that I have an issue oftentimes where I can't find an ideal exit for a real estate project. This is a great strategy for me personally. And I know that there's a lot of other investors that have the same pain. And so that's the backstory to how this got up and off the ground. It was by accident. I taught a class and I realized I needed to do this for myself. I have some fund management experience early in my career, and I have a good friend of mine became my partner that is an extremely experienced fund manager. So that's how this came to life. Pretty funny story, but it was by accident.
All the best ideas come by accident. Maybe step back.
It was serendipitous.
It always seems to happen that way. Let's step back for folks for a second. So I think maybe a lot of folks listening may not be familiar with what is an Opportunity Zone Fund. Can you maybe describe what that is from a high level for folks?
Absolutely. So this was birthed out of the 2017 Tax Act, and it is the Tax Act allowed for opportunity zones to be created, which it's really the lower 20 or 25%, I can't remember, of income areas are designated by each state as opportunity zones. And it is a tax incentive that I'll get into the details in a minute, but it allows investors to move money into the opportunity zone area through what's called a qualified opportunity fund, a QOF. And so it's a brilliant move from a tax standpoint because it helps underserved areas have a massive attraction of capital, and it allows investors to have the best capital gains mitigation strategy I've ever seen outside of maybe an ideal, 1031 or perfectly fitting other option. So it's a really cool tax strategy that benefits both lower income areas and investors where everybody wins.
That's perfect. And from an investor perspective, what's the benefit here? Why am I looking at this as an investor? There's deferral of
Sure.
capital gains, but it goes beyond that than just for real estate, correct?
It does. It's not just. I approached it first from a real estate perspective, but it's really any capital gains are eligible to be moved into a qualified opportunity fund. And the benefit for the investor is a deferment of paying any capital gains tax until April of 2027. That may get extended. We're not banking on it, but
Mhm.
deferment till April of 2027. But the best part is that all of the growth that takes place inside of the fund, as long as those funds stay in a QOF for a 10-year window, all of the growth will exit tax free, very much like a Roth IRA treatment.
Mhm.
So, absolutely amazing to be able to have an unlimited amount of capital gains that can go into a fund, grow and exit tax free with a deferment of the actual tax due for up until that 2027 window. So pretty amazing from my perspective. And there was some other benefits that have already expired. There was a step up in basis for 10% of those gains and 15% based on when the contribution came in. That's no longer in place. But the best part in my mind is anytime you can defer tax for, as long as possible. In this case, another, what is it going to be, 4 years and change. And best part of all, compound growth over time, exiting tax free. That's pretty amazing.
And we've been sort of peeking at this from our desk is we're usually, as our listeners know, aiming at real estate investors that have 1031 exchange needs and are looking to be passive. We're looking at Delaware statutory trust as a passive option for them. This is another option. It's a little bit different if we're talking about opportunity zones. What can you do here? You can invest the gain, not the entire proceeds. So this is an opportunity for some liquidity for an investor that normally they wouldn't see in a 1031 exchange, correct?
That's exactly right, and that's one of the beauties of this is that you can separate your basis from your gains, and just sort of a simple example is that which is pretty rare. I mean, instead of having to move everything down line to be able to pull liquidity from your basis and push only the gains into the QOF, that's pretty cool. So there's our fund, we're actually eligible for cash investments, but the significant upside in this case is, of course, to be able to have that capital gains tax play. But I haven't seen anything where you could separate the two, take your initial principal, put it back to work wherever you want to put it back to work, and then take the gain portion and put that into the QOF strategy.
You talk about, we get excited as investment advisors to talk about diversification for some strange reasons. It makes us really excited. And so, what an opportunity to do this if you have a very concentrated real estate book, which frankly is most of our clients. They've decided to be real estate investors. They're good at it. They've made a lot of money doing it. Here's an opportunity to diversify that you wouldn't have normally, and you still have some incredible benefits here from a tax deferral perspective as well. You're taking a little bit of money off the table. And aside with that is always with the Delaware Statutory Trust, we get a little bit, our investors get a little bit skittish. It was like, wait a second. So how long am I going to hold this investment? And we're like, probably maybe 10 years. Like, ooh, 10 years. Okay. And I can't get my money out? No, it's really hard. Like, okay. And you can kind of see like faces of nervousness kind of appearing in front of you. You go, well, there's other options. And so this could be one of them where we talk about there's an opportunity for some liquidity here. So this is great. So, all right. So I think we've covered sort of opportunity zone funds generally. Talk to us a little bit about what you're working on with Cyrus. Where's the focus, and how far along are you guys?
Yeah, absolutely. So my this was set up initially to serve real estate investors, and our sweet spot is we've found is below some of the bigger Wall Street funds, and then above, kind of just above the mom and pop. And there's a lot of inefficiencies that exist in that world. So there's a couple of areas that we find are beneficial and have generated really good returns, and that's really the spot. Part of this comes, I've got 20 years of relationships with local real estate professionals and have been an investor for many of them, and we become known as a cash buyer for many of these folks. And so a lot of the things that we're able to see are, off market opportunities that again are below a certain threshold and just above another area. So our model is to, we're in Southern California primarily, have a couple projects elsewhere, but that's where we have a lot of ability to buy very well, buy into value, know the markets very, very well. I've got just about 300 plus hours of research into looking at what are the similarities and what are the differences between the market we're in today and the Great Recession era, which is pretty fascinating. Maybe we can get to that in a little bit, but have a tremendous amount of intel on what's happening locally. We're in the process of building 100 build to rent units, and we see the tailwinds of rental pressure, and we see the significant undersupply of housing that exists. So our strategy is buy deep, work with the demographics, work along, the demographics are a nice tailwind for what we're doing. And then, find the inefficiencies that exist that are just not in the mom and pop bite size.
I'm not going to leave that nugget out there without you describing it. Tell me about this research. Where are we at in this cycle? Tell us more, please.
Sure. It's really interesting. I mean, if you want an idea of what's going to happen to residential housing, I mean, we have to look at the basics of supply and the basic supply and demand. And we also have to look at what are the affordability issues, which is significant right now, but then also what is the credit market? And so we have a talk we do fairly systematically. That's about 45 minutes. So I'll give you the super condensed version of this. But right now, if we look at the things that impact supply and demand, one of the key differences that we have between today and 2008 is there is a dramatic undersupply of housing that exists nationwide. It's serious. It's a serious issue. Like we just dropped below 1 million for nationwide available inventory between available plus pendings. And even with a dramatic reduction of buyers, and you look at it takes time sometimes for an economy to acclimate to a dramatic shift, which we've had in interest rates with 30-year rates going from 3 up into the 7s and now back into the low 6s. So there's some significant pent-up demand, but the other thing that no one's really talking about is there's a wave of new buyers coming into the marketplace of millennials, which is significant. I mean, it is larger than the boomer generation. People on average buy when they're at age 33. I think it just ticked over to age 34, pent-up demand. But if you look at year-over-year birth rates, there's a wave coming in that we are just on the early stages of. And something very different today than 2008 is there was a dramatic fall off of new buyers coming into the marketplace just after 2006, 7, 8, 9, and 10, dramatic reduction of people coming to the marketplace with a massive amount of oversupply. And we have a significant amount of undersupply right now. So there's a few things there, but just as we look at the basics, the fundamentals, regardless of what happens short term, because we all know both psychology and fundamentals drive the market. Fundamentals win over time, but psychology can swing it and exacerbate it one way or another, greed and fear. And we've got some fear right now that's causing a significant amount of pent-up demand that's going to inevitably play through, sort of like the tide coming in over the next number of years.
I love it. Yeah, we kind of like to say here that demographics are sort of undefeated. It's sort of hard to beat them back. It's like death, taxes, and demographics seem to win the day. People need somewhere to live, and what are they going to do? And so some of these options that you talk about, and this is one of the aspects of opportunity zones we sort of really like, besides the benefits that we've talked about, is there's an opportunity here to provide value and to do good for folks. Like we need this. It's something our society needs. And here you are at the front lines able to invest in it. Like what a perfect thing to do.
There's I think it's Charlie Munger that says, show me the incentive and I will show you the behavior. And we have an incentive created to be able to allow investors to defer capital gains and have tax-free compounding growth and exit. And guess what's going to happen? Money is going to go into those various areas. To me, it's really important. Two separate things have to happen. Number one, the tax play is amazing, but that is never, you don't never want the tail to wag the dog. You never want that to be at the expense of investment returns.
Yes.
And so the investment has to be sound and strategic and be able to move with the markets. And that needs to be complemented by the benefit of, the tax enhancements. Both of those, no compromise on either of those.
We've seen one too many luxury high rises inside of a quote unquote opportunity zone. And we scratch our head a little bit and say, where's the functional utility of that? I don't understand it. And we also, I'll be very critical, we also look at that and say, letter of the law, maybe. Spirit of the law, definitely not. To say the least, is that fitting? So we kind of look at that sideways a little bit, and it doesn't. I think it plays off your criteria there. It just doesn't. It doesn't align there. And so when there is alignment, I think that makes a ton of sense. Any pressure from your perspective on? Talk to us a little bit about maintaining the rules of the Opportunity Zone Fund. We've read our way through a bunch of these, and it's not easy to think about maintaining some of these rules and to run this fund. It's a task that you've taken on. Talk to us about some of those rules and staying, in essence, compliant.
Sure. We've got outstanding tax counsel, and my business partner that's our fund manager we stay well inside of the line. I mean, it's just our goal is not to push the limits on anything, but it's to be true and steady and safe, and build our units that are going to really serve the entry level of the market in the various opportunity zones that we know we can buy deep enough where there's going to be value. And also not banking on massive appreciation. I mean, our market, our real estate market, is much more like the 1980s than it was back in the 07, 8, and 9. I think a lot of people just look at 08 and 9 and think that we had a run up and we have a run up again, and so we're going to do the same thing. Totally different. But if we look at the 80s, we went sideways and slightly up for a long time. We actually lost some value in the 80s based on the difference between real and nominal growth. And we'll see how this plays out. What if the Fed is able to tame inflations with their super sharp increase in federal funds and discount rate. But our game plan is not to be risky. It's to be true, steady, get solid returns. And we enhance that. We're able to, one of the things that's an advantage for us is we're able to do we have to do this pretty deep because of the OZ requirements, but we do some fix and flip projects and have, again, years of realtor relationships. We're able to get looks at things that don't ever hit the MLS, which is a huge advantage for us. So we're able to enhance the returns because we all know the money's made when you buy. Like we're not banking on, I hope we get appreciation so we can make money. We buy right, we build efficiently, we play in the space above mom and pop and below the Wall Street funds. And then we have a series of these different rehab projects that come up as well that will enhance the returns. Just a lot of it has to do with longstanding relationships that know that we're buyers that perform.
So much I want to pick out. So I want to shout it again with like a megaphone. This is not 08, 09. And I feel horrible for folks because I think it's such a scarring experience. I've been there. I was on the front lines. I was working at a hedge fund at the time. We were doing fixed income financing, repos. We were looking at subprime mortgages. I mean, the front of the line. I've been there, so I know what the scars are, and they're deep. This isn't 08, 09. 08, 09 happened once. It's not happening again. It will happen again from a mark. We've already seen it in stocks. Like we've seen the hit. It happened, guys. Like most folks I look at are down, 28, 30% last year. Like that's deep. and inflation's real, but that's not 0809. That's not what we're looking at. This is something different.
Yeah.
So I like that they kind of put it that way, that this has more, it's more analogy to an 80s real estate market that I doubt a lot of folks probably remember or even had an opportunity to live through, right?
Yeah, it is very similar to the 80s and very different than '08 and '09. And I can tell you also, just I'm a partner in a mortgage banking group, Churchill Mortgage for California, Nevada, and so our group, we've helped about 5,000 people over the last 5 years with purchase or refinance. And so I have firsthand street level knowledge of the quality of credit of the buyers today and
Mm-hmm.
how that compares back to 15 years ago. And it is a night and day difference.
Mm-hmm.
There is equity required. That's another thing. If we look at equity positions nationwide, and something very few people know is that 27% of all buyers in this market are cash buyers.
Mm.
1/3 of buyers are first-time buyers, and there's significant affordability issues. And then the other, 40%, there's not affordability issues. They are just not excited about a 6 or 7% interest rate, and so slow playing any move to potentially sell and buy again and get out of their 3% mortgage. So there's some landlock that's taking place, but the market from a fundamental standpoint and demographic tailwinds and supply demand in terms of number of properties available and people that will need or want properties, whether they're stepping out now or will in the near future, it's just so very different. So those are things that we spend a lot of time in the data to make sure, number one, that we can advise our clients that are looking to buy homes. A lot of people are anxious because they think, they think there's a crash coming. I just heard this. I haven't validated it, but I just heard that from a very reliable source, but it was the most searched, at least in the real estate mortgage world, the most searched Google terms are Fed, recession, inflation, and housing crash. Okay. It tells you where people's minds are.
Yeah.
There's a lot of fear and uncertainty out there. And the reality is that it's under the surface is just so very, very different. So what we do have to do is we have to play through and allow the psychology to swing how it's going to swing while the fundamentals, while the tide moves the direction it's going to inevitably move. And so that's why there's uncertainty in the short term, for 2023. But as far as expecting the bottom to fall out in the housing market, we need some sort of black swan event that is, not on the radar at all for anyone, or we would need interest rates to move up in the eights in order for there to be, pretty significant correction. That could impact things, but we don't see that in the cards.
100% agree. 100% agree. Yeah, we want to start with the differentiators. I mean, credit quality look at what banks did when we hit COVID, right? They're out there looking to help borrowers navigate their way through that crisis because they're in a strong enough position to do that. They still are, right? And that's a huge difference because that was the foundation, one of the foundational pieces of the last crisis. And that level of instability in our financial system, it will wreak havoc. We don't really have that right now. It doesn't exist. So when you have that kind of strong backbone, well put, we can sort of navigate our way through this before these longer term trends just sort of take hold. Absolutely spot on.
There's when we look at the foreclosure data and the forbearance data, sometimes we'll see the headlines that foreclosures have doubled, but the question is doubled from what, right? And what is not apparent until you look under the surface is that the foreclosures were halted, and there was a lot of folks that went into forbearance, just under 5 million. But when you look at the forbearance numbers now, it's down to I think 400,000. The majority of them have worked out. And then on the foreclosure side, even though they've doubled, if that was the headline I saw recently, we're still under the last 50-year run rate of where foreclosures typically trend, 1% plus or minus. So that's one of the things that's a pet peeve of mine is just, the media is not your friend, and they're out there getting the eyeballs they need, but scaring people about the housing market when the fundamentals of where we're going are just, they're very different than the Great Recession.
Yeah, maybe a great opportunity to take advantage of that as an investor at this point. to maybe take advantage of
100%.
some of that headline risk that you're seeing and to kind of get involved. So very, very interesting. This is awesome, Mike. I think these viewpoints are very interesting. Mostly because they align with mine. No, I'm just kidding. No, but it's this is data driven for folks that are listening. These are data driven viewpoints that go underneath the headlines, and they're just what they are. And so, what a tremendous opportunity that you have right here to invest in these areas and to provide a need. The other thing I wanted to hit on that I think is very important that we talk a lot about is where you're operating. And so you mentioned operating underneath Wall Street, but above mom and pop. Talk about that a little bit more. I think that's really important.
Sure. One of the things that's bothered me is why more people are not aware of the opportunity zone strategy. And it finally dawned on me that, all of the ultra elites are doing this. Like it is just part of, family offices. It's just what they do. But it's not, it's too new, and it's not something that would typically be, a broker dealer sanctioned option. So it's just sort of in this odd space, and most tax professionals are backward looking, not necessarily forward planning. So there's a gap that exists there. So from first of all, from an availability standpoint, again, I stumbled on it by accident. If I didn't have to do that talk, this would have been totally off my radar, and I would have been paying on all, because I do a lot of real estate projects. I would have been paying, unless I find the ideal down lake solution. It kind of makes me sick to some of the capital gains I paid over the years, and I would have paid from when we launched 2 years ago till now, right? Because I just didn't know. But coming to find this, I realized there's a lot of other investors like me that might have, 100,000. We have 100,000 minimum for the fund, accredited investors only, Reg D fund, and we have entry points into the fund in January and July, because those are evaluations period. But one thing that I don't think most people know about the OZ is it's not like you sell and the funds go to accommodator and then they move into a qualified opportunity fund. You can actually sell a property, receive the proceeds in your bank account, and you have 180 days to move it from your account into a qualified opportunity fund, which is the reason we have January and July openings, to be able to accommodate, the entire year. So the 180 days applies, but it's not to find another property and close. It's to be able to move it from you and your possession into a QOF. So I thought that was the level of latitude that was given for, the opportunity zone strategy was well thought through on that front. And I don't know that most investors are aware they could have a busted 1031 exchange, get a check, and I've had them, get a check back, and then say, fantastic, now I've got 180 days to move it from me into a QOF, and notify the IRS that this money is not taxable today. It'll be moved until 2027, and then move into whatever the ideal strategy is. If a fund like ours fits, then fantastic. But that's something that I think investors need to know, because a lot have received constructive receipt of gains in the last 180 days and don't know there's an option.
100%. Just talked through one this morning with the QI, and I was explaining all this to them because they didn't know. They had no idea that this was an option. They're like, well, what do you want us to do? I'm like, well, it's broken. I want you to send a couple wires. They're like, you sure you want us to send some back to the client? Like, yes, you can do that. Here's where we're going to send the gain. It's going to go somewhere else into a fund, and we're off and running. And I think it neglects, I don't know if we mentioned it, but real estate works here. And I think you and I are so focused around real estate. So we talk about the gains there. But if you've sold a business, or you still have gains from stock sales, any other gain that's not real estate, there is no other option. This is the only deferral game in town.
Spot on. I have a friend of mine that's a business broker, and this is a value add, sort of additional discussion that he has for his sellers as part of their overall tax planning strategy is the QOF for some or all the gains. That's the other part is it's not like you have to move all the gains. There's complete latitude. One investor that we had sold a property and had, I don't know, it was 400,000 or 500,000 of gains, and he had minimal basis. Long story short, he's like, I need some of this. So he put in, a smaller block and paid tax on the others. There's just options. And I think what people need to know is that there's options to be able to mitigate tax that are once in a lifetime. This sunsets in 2026.
Yep.
Like it's gone after that. So it's
Yep.
like we've got from the 2017 Tax Act to 2026 to be able to move into a QOF and have all those gains ride and exit tax free, and it'll sunset in a couple years. So as much as that's the reason that I think this is important, is that it took a lot of bipartisan activity to get this in place initially. I don't know when something like this will come around again, but we've got a few more years.
Yeah, it's interesting. And we start to do the math on that deferral, because you do have to pay. There is a tax bill that's due, and there's a date that it's due. So the closer and closer we get to that date, the less and less compelling, unfortunately, this becomes, right? And so I'm sure you do, we have our fingers crossed too. I know there's legislation out there that would do some extending onto this program. And gosh, by all intents and purposes, this seems to be working, with some adjustments that maybe need to be made, and that's fine. But this is working. I mean, people are investing significant amounts of capital into these opportunity zone funds. And you're right, as we sort of started to poke our way around here, we kind of butted heads into some pretty large institutional players when we started poking around to some of the other funds, and we're like, okay, I see who's playing in this game, right? It's some of these bigger dollar shops and bigger dollar family offices that are playing here. And so I think we're onto something there. But hopefully we get some extension of this. And you're right, there was, I don't know, maybe it's the first piece of bipartisan legislation that's passed in the last decade. I joke, but it is good to see that, both sides of the aisle are vested in this, and they see value here because there is. So it gives us a lot of hope that maybe we get an extension, maybe we get some different rules that help continue to breathe life into this thing.
Right. No, I agree. We've set up the ability to, just because of the tax trigger at the end of 2026 and due April 2027, we've set up the ability for an investor to be able to margin with a wash loan against their account up to, I don't remember if it's 20 or 25% of their balance, if they don't have outside liquidity to be able to pay the fund. I've set this up to be as investor friendly as could possibly exist, just because I'm solving my own pain, so to speak, and I know that every other investor has the same thing. So that's the rationale for doing that. Is some investors will have the liquidity to pay the tax, others may not. So at that point, if they need a wash margin loan, then the investment can stand on its own, and then the remainder of the funds can continue to grow and exit tax free. So that's the way we've set this up.
Well done. It's one of the first questions that we ask of folks in your seat is, is there a mechanism for some level of liquidity to pay that bill? So it's perfect. Right. You're right. It's amazing what happens when you try to solve your own problems. It sort of makes it come to, lo and behold, others have the same issue, and you're solving it for many people, isn't it?
Human beings are by and large the same. They want the same things. I want a better life for me and my family. I want to be able to build wealth unencumbered. I'm happy to can contribute. I mean, it's just, we're all after the same things, and so I do think when things like this come around, you have to take advantage of it. And regardless of like the complications that exist in the world, or just, we were talking internally with the team just today or yesterday on, if you could be born, because it seems like there's just challenges in the world today. It's like, no, we need a reframe. If you had to be born in any time and any place in history, is there a better time and better place to just exist and live and build and thrive? Like, there isn't, and if you had to randomly show up and deal with any quote crisis that exists, and you would just land in history at some point to experience a crisis, it's like, I'll take what we just went through any day and twice on Sunday compared to some of the just craziness and atrocities that have happened throughout recorded history. So a lot of times, like, I think life is just a helpful perspective can go a long way. I mean, we've got 7.9 billion people on this planet, and how many people would want to trade places with anybody that's listening to this call right now, right? It's just,
100%.
I think we're all very, very fortunate. So when we run into like little issues, sometimes I have to give myself a little wake up call to think, you know what, it's really not that big a deal. I can solve it. Life is good, and we're going to continue to make it better.
I'll often repost on LinkedIn occasionally. We've never lived longer in recorded human history than now. It's COVID included. There's never been less extreme poverty in the world than there is now in human history. It is truly statistically, everything else aside, it is the greatest time to be alive. And we're talking in the most prosperous country in that setup of being alive. So I can't, all opportunities, no issues, nothing too big we can't solve. We're all blessed. You're right on there, Mike. I'm with you.
100%. And it's safer too. We just hear about things much faster, but the reality is all of
Yes.
the data, all the stats, exactly what you said. It's life is good, and I think sometimes a friendly reminder of that can help people focus on the positive, not the negative.
Just need people to click on the good stuff more often, and then you get to hear about it more often. That's how it works. It's a feedback loop, folks.
That's
If
right.
you want positive news, click on the positive news, and it'll show up for you. Mike, this has been great. Where can our listeners find you? Where can they learn more about what you're doing with the Cyrus Opportunity Zone Fund?
Yeah, absolutely. But best email is Mike at cyrusozfund.com. Website is cyrusozfund.com. And then more about me personally, MikeHardyBio.com is you can connect on LinkedIn and other social platforms through MikeHardyBio.com. But yeah, this has been a super fun conversation, and I think it's the world's best kept secret right now, at least for a few more years. But yeah, life's a gift, and I think that every day we have the opportunity to make the most of it. And I've certainly enjoyed our conversation very, very much.
Thanks so much, Mike, for joining us, and thank you everybody for listening. We will talk to you and see you next time. Bye bye.